Is Synovus a buy or a sell? Let's get started with the model. This is a large cap company, 40 billion market cap. They're trading at 22 Canadian dollars a share, and they have 1.8 billion shares outstanding. Synovus develops, produces, refines, transports, and markets crude oil, natural gas, and refined petroleum products. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a lot from 2021 to 2022, the highest ever, 7.6 billion. We're looking at the ticker that trades on the TSX since they report in Canadian dollars. Free cash flow dropped 60% to 3.1 billion in 2023, up to 5.4 billion in the trailing 12 months. Margins are a bit low, between 6 and 11%. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was really low in 2021, jumping to 6.4 billion in 2022. That was the highest ever, down to 4 billion in 23, a little under 4 billion in the trailing 12 months. Margins between 1 and 9%. The reason their net income was so low is because of an asset impairment. That's a non-cash item. That's why their free cash flow was still high. Revenue is a sales for the company, and that went from 50 billion over 70 billion, a growth of 50%. Then it dropped to 55 billion, up to 59 billion in the trailing 12 months. Their revenue and profits are tied to the price of oil. So when oil prices are really high, so is their revenue. If oil prices come down, so does their revenue. They pay a nice dividend, 3.25%, and they could cover that dividend 4 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 62 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $56 billion. We divide that by 1.8 billion shares. And we get a calculated stock price of 31. They're trading at 22, so they're trading at a 28% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 11 companies in the same industry as Synovus, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. All these numbers are in US dollars because all the other tickers trade in the US. So I converted everything, their revenue, their stock price, to US dollars. They spent 3.5 billion in CapEx. Exxon spends the most, 24 billion. They have a good debt to equity ratio, 0.3. That means for every dollar of equity, 30 cents of debt. They pay a good dividend equal to the median. BP, the British company, pays the highest, 6.1%. Their free cash flow is between the median and average. They rank 7th in market cap. Exxon's number 1, then Chevron. Total Energy is number 3. The Canadian company Suncor is number 5 at 51 billion. Their price to book is equal to the median. They're trading at 11 times earnings, which is better than the median. Trading at 7.5 times free cash flow, also better than median. And their price to sales is equal to the median, so they have really good ratios. They generate 41 billion of revenue, more than Imperial and more than Suncor. They're not growing that much. Their 5-year annual revenue growth rate is only 1%, the lowest on this list. And they're trading pretty close to their 52-week low, only 9% off, and 26 below their 52-week high. So it looks like there's a lot of upward potential. Look at this crappy company, Vivicor. They're trading 99% off their 52-week low. If you put $10,000 into this company 10 years ago, you would not be happy at $8,500 today. That's assuming you reinvested the dividends, a 15% loss. But if you bought the stock, say 3 years ago, you would be up like 200-300%. So to summarize, I have them trading at a 28% discount. I give them a ranking of 7 out of 10. They're a solid company with a long history. I would definitely buy the stock, short-term and long-term, 8 out of 10. They have really good ratios, better or equal than the median in every category. Financials look good, 7 out of 10. The only reason it's not higher is because their revenue is not growing as much, but their free cash flow looks pretty good. Let's take a look at their MD&A for the third quarter. Unaudited. All the numbers are in Canadian dollars. Their upstream volume for the quarter is 771 million barrels. That's barrels per day. Upstream is in the beginning part of the oil and production process. It's the exploration and production part. That is lower than the last 4 quarters. It was around 800 million barrels the last 4 quarters. 674 million barrels in the downstream part. Downstream is closer to us. When we get gas from the gas station, that's real close to the downstream part. It goes from upstream to midstream to downstream. And that is a little lower than the third quarter of 2023, 691 million barrels. Crude oil throughput, 642 million. Downstream volume, 685 million. And their revenue for the quarter is 14 billion, a little higher last year, also a little higher last quarter. Operating profit, 2.4 billion. It was a lot higher last year. It was 4.4 billion last year. Operating cash flow, 2.5 billion. It was 2.7 billion last year. And their net profit for the quarter is 820 million, EPS 44 cents. Total assets 55 billion, liabilities 19 billion. And they give us their debt, 7.2 billion. And they have 3 billion of cash because debt minus cash is net debt, 4.1 billion of net debt. They paid out 329 million of dividends to their common shareholders. That's 18 cents each. Here's a breakdown of the production volume by segment. Oil sands, 588 million. Lots of oil sands in Alberta. Conventional oil, 118 million. Offshore, 66 million. Offshore is when they pull the oil on coastlines or actually in the water. The more difficult it is to pull the oil, the more expensive it is. They pull a lot of bitumen, 570 million barrels. Some people call bitumen asphalt. It's used to make roads. It's also used for roofing. Conventional natural gas, 844 million cubic feet per day. And you can see it costs a lot more offshore. It costs $18 a barrel. Oil sands is a lot cheaper at $11 a barrel. That's why they don't do much offshore. You get a better return with oil sands and conventional. Here's a look at their downstream portion. Canadian refining, 99 million barrels of oil per day. US, 540 million. Gasoline is their most popular, then distillates, and they footnote that it includes diesel and jet fuel. Their operating margin for the quarter is 2.4 billion, 16 billion of revenue minus these expenses. They give a breakdown of the 2.4 billion, that's a dark blue line. Oil sands, 2.5 billion, conventional, 12 million. This is just operating profit. Offshore, 250 million. Canadian refining, 60 million. And they have a loss of 383 million in U.S. refining. They mention lower market crack spreads impacting our U.S. refining segment. Let's look at a stock on Simply Wall Street. Its last price, 22, 40 billion market cap. Flat in the past week, down 5% in the past year. Here's their stock price since 2009. It was 27 a share. In 2011 at 39. It got real low during COVID, $2.35. Amazing time to pick it up. And then it had a nice run up to 30 in mid-2022. And then it's been trading between 20 and 30 since then. Simply Wall Street's value is 58. They say the stock is 62% undervalued. 17 analysts priced this stock at 32. They also say it's undervalued. Their revenue in 2013 was $19 billion. And it was still $19 billion in 2021. It didn't go anywhere. Then it jumped up a lot in 2022, 67 billion. It has come down since that peak. It's currently at 56 billion. They had 6.5 billion of equity in 2013. It got up to 13 billion in 2017, then came down, then right back up to 14 billion in 2021. It has come down quite a bit since then, cut in half to 7 billion currently. But when you look at their equity, it looks like they have a pretty solid balance sheet, equity of 29 billion. And they have 3 billion of cash, plenty of cash to service the debt. In the past year, lots of people have been buying the stock. There was one sell. It was a big sell for nearly 400,000 shares, but a lot of small buys, as you can see here. But that one sell is almost equal to all the buys. Actually, all the buys are closer to 500,000 shares. Half the companies are owned by institutions, 20% by the general public, 17% by public companies, and 13% by private companies. The Hong Kong investor, CK Hutchinson, is the biggest shareholder at 17%. Then Capital Research, Fidelity, RBC, BMO, a couple of big Canadian banks, another RBC, CIBC. Their employee count went up a lot. It was 3,500 in 2013, now it's 6,900. And the ticker trades on the New York Stock Exchange, Mexican Bolsa, Toronto Stock Exchange, Deutsche Börse, also the OTC pink sheets. So if you want to learn how to value a stock, you can get my discounted cash flow model for free. Click on the video in the top right corner.